trade in the markets. Now, I am what they define as a price action trader. Say, what is it? What is a price action trader? Well, to really understand price action means you need to study what happened in the past, then observe what is happening in the present, and then predict where the market will go in the future. A price action trader relies on his charts, but he relies on the movement of price on his charts. He doesn't rely on fundamental news. He doesn't rely on economic events. He doesn't really rely on technical indicators. He is looking for price movement on his chart and other things directly on the chart, like a trend line, because that's over top of price action, or support and resistance lines that's on your chart over, or a chart pattern, because that's developed on price action. But he's looking at the price movement on the chart. That is the primary decision. What is prices doing on the chart? Price action is among the most popular trading concepts. A trader who knows how to use price action the right way can often improve his performance and his way of looking at charts significantly. So what is price action? It's a favorite amongst short-term and medium-term traders. Price action trading brings together an interesting mix of information and different views. These include historic price patterns, technical indicators, and investors' ability to read the market. Many investors see the stock market as an information exchange, where all views and strategies meet and try to arrive at a fair price in the end. This explains why price action trading strategies do not involve fundamental analysis of an individual market or commodity. We're not looking at Google's earnings report. We're not looking at target sales. Okay, we're looking at how price is moving on our chart. As many of the decisions associated with price action trading are subjective, what one investor may see as a breakout, another may see as a potential price reversal. Compare and contrast this with pure technical indicators or analysis, where you effectively ignore the experience of the investors in favor of cold, hard trends. So in other words, when you're trading with pure technical analysis, which could be defined sometimes as that's what most black boxes are based on, most robotic trading, because they are completely rule-based. Means that everybody who's using RSI stochastics and Bollinger Bands, who's looking at volume, is going to come up with the same decision simultaneously. Where when you're looking at price action and support and resistance and breakouts, your decision may be much different than the guy sitting across the hall from you. But you're not making a decision based on mathematics and something telling you when this happens, do this. You're making it based on your experience and your comfort zone. And it's one of the reasons price action traders stick to just a few handfuls of assets to trade, because they get deep into the personality of that asset. They can see what's happening. Is understanding what that price on the chart and what the price action is telling you is happening. So the key to reading price action on charts is to take in short-term fluctuations, because as a short-term trader, CFD trader, we don't care if the dollar is getting very strong. We don't care if the dollar is getting very weak. We don't care that the Federal Reserve is talking about tapering. So if they do, the dollar is going to increase in value. Do I care? Do you care? Not really. What we do care about is the euro dollar was trading at 124, 122 this morning, and it hit a level of resistance at 122.6, bounced off of it and fell back down and was not able to go back up to that level of resistance. That's what prices do. And all we care about is what, as a short-term trader, is what is it going to do over the next 2 hours. If it hit 122.6 but wasn't able to break, fell down to the next support level at 121.5, bounced off and is moving back up, we know the probability of it's going to go back towards that 122.6. We don't know if it's going to break that 122.6. But all we're looking to do is make the profit between that 121.5 and that 121.6. So we use things like trend lines, moving average, support and resistance, and candlesticks. For example, when a chart is about to crash through a support level, it is likely to do it in one fell swoop, or it's unlikely. Excuse me. Price has a tendency to stop at certain areas. Doesn't mean it's not going to go straight through it and go down, but it will stop and take a breather at a certain level and then go through it, because price doesn't move in just one fell swoop up and down. You're not going to see price go like that. Although we did see that with Bitcoin the other day. You're going to see price go like this, like this, like this, like this. Now, when we come to a psychological level, it could go right through it, but most likely it's going to come like that. It may congest on it, and then it'll go right through it. But it could come up to that level and come back down, then make attempts again, come back down, make attempts in. But this is looking at price action on charts. So eventually the price will crash through the support level, often prompting an array of short selling. So next, let's take a look at a few trading strategies based on a variety of different chart patterns in more detail. So let me pop up some live charts here. Okay, let's go to my Euro US dollar. Now what we're looking at is the Euro US dollar 1 hour chart. This is my standard teaching chart. I haven't brought it up here because I'm suggesting to trade the euro. I haven't even been watching the euro that close since early this morning. Okay. But what we were talking about just now was we saw the euro break through this level of support. It congested here, it pushed back up there, couldn't break through this level of resistance. And what did it do? It fell back down to this support level. Okay. Now, it's probably going to make another attempt moving up here. Now, we don't know whether it's going to go through there or break through. We don't know if it's going to come down here. But there's a good chance that it's going to make an attempt. So looking at price action and combining this with maybe moving averages or other levels of support and resistance, and looking for maybe a chart pattern or looking for maybe a bearish or bullish engulfing candle might give us a final answer. Because we do have an uptrend in price. So we do have the momentum carrying price higher. So we would expect it to continue its trend, and we would expect it to continue up. So it might be an advantage, a opportunity to trade when it bounces off and it doesn't break through and comes back down to here. Maybe it's an opportunity to sell down to this level. But this is looking at price action, only a price. Now, these levels are significant levels. And these levels are called support and resistance levels. Now, I should probably be adding a new one to my charts, because look how crucial this level was right here. Now, support and resistance levels come from historic price movements. Now, I'm not going to get in today to color coding and keys, because you see, this is my chart. And when I teach support and resistance, we'll talk about how to color code your lines and levels, because some of these levels were established a year ago when the euro was trading at this level. Some of these were established a couple weeks ago when the euro was trading at these levels. Some of them have what we call minor or major levels. Okay? And I color code mine, my own key that I use for my own map, to tell me something so I know how important each of those levels were. So these red levels tell me that these were major price levels the last time and the time before that the euro was trading this level. My light beige ones here tell me that they were also important levels, but these are over a year old. Historically, it doesn't matter how old they are. The older they are and the more they've held, because look, as price was moving up, look how important this level was here. Then look how important it was here. Didn't have to do much here, but then this one, look at all the congestion on this level. Look what happened here. Look what happened here. And this price has been, this is a price level that was put on the charts a year ago. So this is helping us define price action trading. We're looking at our price chart and looking to try to see what price is telling us. And we're looking at making our decisions based on what price is telling us. Because lots of people like trading from indicators, okay, like RSI, stochastics, and Bollinger Bands, and commodity output levels, and all those are fine if you then want to be a technical analyst or you want to be a technical trader. Now, reading a chart is still falls under technical analysis, but there's many fields of technical analysis. We have price action traders, we have pattern traders, we have technical indicator traders. Okay. I don't use indicators at all. Now, indicators, too many people forget the word indicators. Technical indicators like RSI are the interpreters of price action. They try to tell you what price action is trying to tell you. So it's an interpreter, like at UN, where they sit and listen in the back room to somebody's speech in another language. But that interpreter is supposed to be a very proficient, excellent interpreter who is using the right slang words, telling you, in your language, so you understand that not just the words that are coming out of the person's mouth, but the gist of what they're saying, and using the right terminology. So technical indicators are supposed to do that, but they're only mathematicals. So it's like you trying to use Google Translate to translate a document. Okay. Now, it's improved with time, but it's still a computer trying to figure things out for you. So even if you want to be a technical trader, you still have to put a lot of price action into understanding what it's saying. So once we have price action on our charts, we can look at a lot of different things. We have breakouts and corrective breaks, because price is always trying to tell us something as it moves. It's being able to, excuse me, it's being able to tell or interpret what price is trying to say to you. One of the best ways that we can do this is using chart patterns, because unfortunately, most traders, especially new traders, think that this is the way price moves. Push, ease, push, ease. It's what we teach, because that's what price moves. It moves in uptrends and downtrends, making higher highs and higher lows, or low downtrends, making lower lows and lower highs. But the fact of the matter, this is what the market actually looks like. Okay. So it's very easy to teach from that, but it's very hard to trade from this. And this is what we have to interpret in order to decide what is happening out there, to risk our money and to make educated trades. So by using price action, we can do things by putting our support and resistance. We can look for price patterns, and we can see our support and resistance levels and see when we should be getting a breakout, whether it's a break up or break down. But we can then start analyzing on our own price action. We can make it complex, or we can make it simple and straightforward. But I am, like I said, a price action trader. I look for support and resistance. I look at candlesticks. I look at chart pattern. No, I don't look at candlestick patterns. I'm not looking for a doji. I'm looking for what the current candle on my chart is telling me in the candle next to it. Now, bullish engulfing and bearish engulfing help somewhat, but I'm still trying to look at whether I have indecision candles. I look to see where the open and the close are for me. I look to see the width of the length of the wicks, because that starts to tell me who's in control of the markets, how stable the markets are. When you have a short body candle with big wicks, that tells you prices all over the place and nobody's in control of anything. When you have a nice body candle and equally sized wicks on either side, and it's a red candle, that tells you the bears are pretty much in control. The opposite is true when you have a green candle, the bulls are in control. Now, you don't have to look and trade from a candlestick chart. You do have a choice to look at a bar chart. I was for many, 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 many years a bar chart trader because, again, I told you, we used to chart by hand. I didn't know anybody those years ago that were candlestick traders. In fact, it was not, candlesticks been around a very long time, but in the old days of hand charting, it was too time consuming. Today, because we have all these Java and HTML charts, charting's become very, very customized, personalized, but very easy to do. So I don't buy into the pattern analysis of candlesticks. I don't believe the teaching of memorizing 72 different candle patterns and what you're supposed to do when you see them is relevant to our type of trading. I do believe being able to read price action through the last few candlesticks is very important. But then I also believe in price patterns. So I believe that price is telling us something when we can see a pattern forming. Now, we have things like head and shoulders patterns. Well, for our type trading, short-term trading, head and shoulders don't help us that much, whether it's an inverted or right side up head and shoulder, because they take too long to develop. And then we have things like double bottoms and double tops. Okay, I don't believe a double bottom and double top tell us much of anything because, again, in our type of trading, to come down and hit a resistance line or support line, bounce off and come right back up to it, that's a double bottom, but they happen so fast and so often that we can't really use them for our type of trading. But when we get to a triple bottom or triple top, then we can see something developing with price action. Because when price becomes stuck between a level of support and resistance and bounces off one, goes back to the other, bounces off one, goes back to, it's not saying it's not going to break out, but it gives you an opportunity, a short-term opportunity, and that's all we're looking for. Now, I am a triangle trader. I firmly believe in triangles, and I include everything from wedges to flags to pennants to asymmetrical ascending into one category called triangles. And what's a triangle? Well, remember at school, it's any pattern that has one line coming at 1 degree, meeting another line at another degree, has a base, and will form an apex. Okay. Now, we have all kinds of definitions depending on what degrees. Like a symmetrical triangle means both of these lines are on the same angle or degree moving towards each other. Then we have interpretations for when we have a horizontal line and a line diverging into each other. What are these, 90 degree? I don't remember what they are. But I don't look at any of those. I don't care what type of formation it is, as long as it falls into the general area of triangles. Because triangles are one of the most important ways that you can trade. Because when price is getting pushed into apex between the support and the resistance line, you know that price is eventually going to break out of that triangle. Which way it breaks, nobody can predict. Lots of people try, but I'm only concerned with when it breaks out. Let price tell me when it breaks out of that candle, out of that pattern. So when it breaks out upward and I have a confirmation candle after it, I have a nice buy situation. If it breaks out downward, I have a sell situation, but it's eventually going to break out of that pattern and do something. So the key to any successful price action trading strategy is to remove peripheral noise such as fundamental data and look at the price patterns, trends, and other forms of technical analysis. When combined with good old-fashioned experience and a feel for the market, this can create a very successful investment strategy. Don't forget, even if you have an open position based on the following price action trading, you need to always, always, always manage your risk. before you ever enter a trade, whether it's a good trade, a great trade, a phenomenal trade, using any of this, whatever price is trying to tell you, you have to figure out what your target's going to be, what your risk reward ratio is going to be based on where you have to put your stop loss to make that trade, and then manage your risk. And you should never, ever, no matter how good that trade looks, trade without a stop loss. So as I was showing before, a good strategy is support and resistance trading. Price moves up, hits a resistance level, falls back down, moves back up, falls back down, moves back up. Now, this doesn't mean it's not going to break out, but we could have gotten a nice trade from here to there. Breaks back off, we would have been closed out at our stop loss. Breaks through, we could leave the trade open. But you have a good opportunity. And there's other ways to see it if you're using a bar chart and something we call an inside bar and a bar inside bar combo. Sometimes we call this a mother bar. And there are all types of strategies, but many price action traders are extremely vigilant. They're always on the lookout for what is known as an inside bar pattern. You can recognize these by the emergence of a secondary bar within the body of the previous bar. So we call this the mother bar. So whenever you have a price bar, a candle, it just appears on your chart. It's always got to be at the end of your chart. And then the next bar is the opposite color and inside the body of that bar. That's called the mother bar and the inside bar. That's telling you something about what price is trying to tell you. And there's all types of strategies using price action trading inside bars. The primary bar is something called the mother bar and will often indicate a period of consolidation and potential turning points from key support and resistance. This is the beginning of a changing trend and marks a downtrend movement. To see one mother bar inside bar occurrence is encouraging. To see two inside bars side by side is an even more reliable indicator. So in other words, we have the mother bar and we have the next two candles forming inside of that bar. But it's looking at what price is doing, reading the candlestick, and at the same time, looking at support and resistance. It is only when you take the time to understand how bar patterns emerge and what they indicate that you can position your trades. Don't forget, also keep one eye on stop losses. As you'll gather from all the information about price action trading is based around trends and momentum. The idea is simple. Once a trend changes, then the momentum often grows. It is only when a stronger opposing trend emerges that the direction changes again. In between these relative strong trend moves, there are periods of consolidation. Sideways trading and prices will often bounce off of support and resistance lines. In many ways, support and resistance levels are self-fulfilling prophecies. Many traders now use technical analysis and take them into consideration. However, price action trading offers the best of both worlds with both technical analysis and human input from a trader. So don't take action with a trade until the market itself confirms your opinion. Being a little bit late in a trade is insurance that your opinion is correct. In other words, don't be an impatient trader. So there are numerous disadvantages to trading simply from price action. But the key to price action trading is to set your stop loss at the closest possible level. So price doesn't move in the direction you have predicted. You don't suffer big losses. And the other thing we want to always look at is volume. Volume should confirm your decision. Now, does price action require discipline? Of course it does. Any trading does. Price action strategies can highlight periods of consolidation, the emergence of new trends, and phases of sideways trading. The key is to see what's in front of you as opposed to trying to manipulate the chart into seeing what you want to see. So the basic difference is that price action incorporates both technical analysis and human input. Effectively, you are monitoring emerging trends and reading these with varying degrees of discipline and experience. While there is a degree of human input with regards to price action trading, there's also a need to be disciplined, even if you're marginally miss out on several trades. The idea is blunt. When the turning point occurs, the momentum builds for a new trend and you will be there. So price action is my best way of trading. It's how I trade. It allows you to uncomplicate the markets and trade with the feel of the markets, but it also means that you can only trade, or you'll only be successful trading a small amount of assets. It's like the guy who likes to race his car on the roads. He likes to drive fast everywhere. He gets his Camaro out on the highway or his Corvette on the highway, and he's jamming 90 and 100 miles an hour, but he's doing it on roads and highways he knows. When he gets into a windy part of the road where he's never been before, he has to be more conservative. So price action is knowing that road, understanding how that asset should function, and understand the ins and outs of that asset so that you know when you can upshift and downshift. You know where that cop's hiding on the side of the road, and you know where the exit is, you know what lane to be in. So as you're flying along, you're not stuck in the wrong place. So thank you very much for joining us tonight, and we'll see you next week where we're going to spend a great deal of time discussing support and resistance. Bye now and have a great trading week.